Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Tad Fallows. He is the co-founder of Long Angle, a private community of over 5,000 first-generation wealth creators, entrepreneurs, tech executives, and professionals with net worths between $5 million and $100 million. After exiting his software company for $26 million, Tad built Long Angle to share access to high-trust, peer conversations around tax strategies, real estate, and alt-asset investing off Wall Street. His experience gives him a rare, data-driven view of how wealthy actually build long-lasting passive income and freedom. I'm looking forward to this, Tad. Welcome to The Wealth Flow.
Thank you so much for having me here, Keith. Really excited for the conversation.
Yeah, I always love to start with kind of people's background, where you grew up and what led you to start a software company.
Yeah. So I grew up mostly in Washington, D.C., although my dad was a journalist. So we actually spent part of my childhood in Malaysia and Japan and South Korea. This was sort of during the, dating myself, but the 80s, the rise of Japan, and that moment where the Imperial Palace was worth more than the entire state of California. So that was living on a journalist's salary in Tokyo was not the most lavish lifestyle then, but mostly in Washington, D.C. And as I mentioned, my dad was a journalist, so I definitely did not come from a business family. I'd always had a sense of entrepreneurship as something that interested me, but that was more out of personal interest. And so out of college, I briefly had a flirtation with being a teacher. Turns out I was not very good. I taught math. I love doing math, but am not very good at teaching math. And so then I went to McKinsey, a management consulting firm. And I spent about 3 years there and really enjoyed that. I thought it was a fantastic experience for somebody shortly out of undergrad, where you're getting to meet literally with CEOs of Fortune 500 companies and you're flying all around the world and that sort of thing, which, today would sound horrible. I've got 2 kids saying, okay, well, you're going to fly to Hong Kong tomorrow and then you'll fly to Geneva and, then you'll be in New York. So like personal nightmare. But when you're 22, like, this is amazing. I'm flying business class and, meeting important people and talking about interesting things. So that was a great experience. And then basically, at the end of that, I either had to say, okay, you can go to business school and come back, or you can really get on the partner track or the career ladder here. And both those sounded interesting, but I didn't really quite feel ready for that. I felt like, hey, I've been studying undergrad, done a lot of academic research there, and then consulting is sort of like a version of academia as well, where you're putting together proposals and thought pieces, but you're not actually getting into the execution. I don't want to say you're not getting your hands dirty. You're working very hard, but you're not actually putting into practice. And I really wanted to take a shot at putting something into practice and try my hand at that and see if I could do it. So I decided rather than go to business school, I would start a software company. I figured after a couple of years, it wouldn't work out. And then I'd come back to McKinsey sort of on the career path there in lieu of an MBA. And that came close to happening, but then we were fortunate enough that the software company did work out. And so we ended up having about a 10-year run there where it grew about 50% a year every year for 10 years, which sounds great. And when you're going from 5 million to 7 million, that's great. When you're going from 20,000 to 30,000 a year in revenue, and then 30 to 45, and you have a new wife. That is a less great dynamic, but fortunately we were able to be successful. And we did, it was software for medical research institutions. So really universities and hospitals, doing basic fundamental research of, nothing kind of applied in clinical trials, just really trying to do the fundamental discovery, mostly on the life science side, which was also just a really interesting experience to meet these people who think, coming probably like you and I from a business background, it's a totally different dynamic where these incredibly smart people working incredibly hard and can do incredibly, could do quite a few things, but are really dedicating themselves not to the pursuit of wealth, but really the pursuit of knowledge and health and that sort of thing, which is pretty inspiring to see such talented people putting their energies in that direction, especially focused on working with cancer centers.
Yeah, for sure. No, that's great. And so the company was eventually bought, and you had a nice exit with it. And I guess tell us what happened from there.
Yeah, so we sold to a company called Agilent Technologies. They're one of those big companies you've never heard of, probably, I don't know, a $50 billion market cap, something like that. But I literally had never heard of them when we entered our sales process. It was funny. We ended up hiring an investment banker, which I am not somebody who generally loves working with brokers and intermediaries. If I'm doing a real estate transaction, I'm thinking, why are these guys getting a 5% cut? They didn't build the house. They didn't pay for the house. Or,
Right.
Similar with a wealth manager, I have a lot more skepticism. But I will say that was one of the best investments we ever made, was hiring an investment banker for that process. So just anecdotally, if you have listeners who are thinking about selling their company, and I think part of the dynamic there is this is a one-time thing. I'd spent literally 10 years building this company, but I'd never tried to sell a company before, and you only have one shot to get it right. And so, just as an illustration of that, when I came into it, I negotiated hard with a banker. I said, hey, it's going to be one of these 5 companies that buy us. So I want to specifically carve them out and saying, you're going to get a much lower fee if we sell one of these 5 companies, because I don't believe you've added value. He ended up finding a company, again, as I said, I hadn't heard of, and we probably had conversations with 60 or 70 companies and got a much better price from Agilent than, any of the ones I'd pre-identified. So we went through that process. We thought about selling to either a private equity firm or a strategic acquirer. And I think there's pros and cons to both. I think the private equity firm is a good fit if you want to roll a lot of your equity and kind of get the quote second bite at the apple and only get partial liquidity but keep a lot invested, and if you want to kind of keep growing the business. I think selling to a strategic is better if you really want to just take your hands off the wheel and said, I had this chapter, I am now giving you my baby, and it's sort of up to you to do with as you choose. And I do think, again, as an aside, if you're a seller, realizing if you sold to a strategic, it is no longer your baby. And so if they cut the sales force, if they eliminate R&D, 2 things which happened to us, that's, you can tell them your recommendation, but ultimately you got paid, so it's no longer your choice. And so, as you can probably tell from that comment there, I didn't last forever at Agilent. I think it's actually, I have a huge amount of respect. I think it's a very well-run company, but just the things it takes to be successful in a company with tens of thousands of employees in terms of, okay, the real skill set in senior management there is cross-functional alignment. And that sounds a bit pejorative, like, oh, I'm dismissing that as unimportant. I actually think it's hugely important. Trying to get 20 or 30,000 people all marching in the same direction is very hard. Yeah. And there's a reason every one of these big companies has a matrix and has the European field organization and has quality and compliance and, internal audit and all this sort of stuff. You kind of need that to keep it going one direction. But I just didn't fundamentally find that as exciting as building a product, selling the product, just sort of doing the doing. So I stayed there for a few years and then ended up kind of in parallel, or really after that, realized that wasn't a fit, starting this community for other people who had gone through a similar wealth journey. So that's a lot of other entrepreneurs, but also maybe people who work at hedge funds, people who work, have been successful in law, in medicine, in real estate, in private equity, whatever it is. So people who in their, 30s or 40s had a significant transition of, say, okay, maybe, grew up sort of in a household with $1 million, and now you are having a household with 10 million or 20 million, sort of different order of magnitude of wealth there. And that tends to come with a different set of questions. Some of those are financial. Estate tax being a perfect example. If you go to most places for public websites for advice on estate tax, the answer is, well, a couple has a $30 million combined exemption, so don't worry about it. So, okay, well, that is accurate information, but if you might actually break that, it is not useful information. You sort of need that. And similar things on things like alternative assets, private equity and that sort of thing, which we might talk about, things like umbrella insurance, et cetera. And then also a lot of things on the non-financial side. So whether that is things like health and travel or raising kids, I would say for anybody of any net worth bracket, probably how to raise your kids well is their biggest challenge. And so I think, some things are less of a worry if you've got money. You say, okay, well, I can send them to private school if that's the best option, or public school if that's best. I'll pick my public district. But then there are new questions. Basically, how do you make sure this wealth is an asset and not a liability for the kids? And that, you basically make sure they have that same sense of being able to achieve on their own terms as you may have had growing up. Because I think a lot of people who've, made money feel like some portion of their success is attributable to having to be scrappy, having to learn to do things themselves. And so making sure you don't remove that, opportunity from your kids, even though you could financially. So anyway, people had a bunch of these same questions. And I would say a lot of people who are in our community, as you described, is kind of these first generation 30s or 40s wealth creators with 5 to 100 or 200 million. They feel like the advice for that is all coming from a Goldman Sachs or a Credit Suisse. And they say, okay, well, that's fine, but I want to get this advice from people who are not trying to sell me anything and don't have a kind of other agenda for it. And so that's why we started the communities. We said, okay, this is just going to be peer-to-peer, people who are in the same situation. Our one rule is you can't take a check from another member. They can't be a client, they can't be an investor. It is really just sort of this unbiased advice. And so we started that about 5 years ago. It has grown. We're actually now at almost 7,000 members. And so it's grown quite a bit over the last 5 years. And in addition to this online sort of like private version of Facebook or Reddit discussions, we have then over the last few years, there's been a set of these sort of specific unmet needs that this group has, some of which is around, for example, access to private market investments. And so, if I want to talk more about that, I can go pretty deep on it over, what we've learned over the last 5 years. But an example there would be people say, hey, maybe I want access to private equity. I'm not a family office, so I can't write a $10 million check into a single vintage of a single PE fund, but maybe I want to write a $100,000 or $200,000 check. If you're looking at any top tier private equity, they're not going to take a $100,000 check. They probably won't even take your phone call. But we, set up SPVs or special purpose vehicles where we have 100 people each put in 100,000, so we can do a collective $10 million check, and we can also leverage, collective expertise for underwriting. Because across these 7,000 members, if we're looking at litigation finance, we have people who work in litigation finance. If we're looking at energy, we have people who run companies in the Permian, so we can kind of take advantage of their expertise to identify, best in class in these private markets and then pool together that money collectively. And then we also do other things like a lot of live events. So we'll do a big annual retreat or local meetups in different cities. And we do some peer advisory groups, which are kind of 8 people meeting once a month on a recurring basis to get to know each other better, act sort of like a personal board of directors. Not everybody does all these. Some people only do 1 or 2. But that's kind of what the community has become.
Okay. No, that's very interesting. And it seems like it's really grown. How did you initially get the word out on that? I mean, to go from, assuming, a few people having a conversation to now 7,000 plus members.
It's almost all been word of mouth referrals, where I think a challenge that most people have is, hey, I don't have a critical mass of friends in the same situation to ask these questions and get trusted advice.
For sure.
But I do have 2 friends. And so if I've got 2 friends and they each have 2 friends and so on, you kind of get that exponential growth. And that is really where most of it's come from. So my co-founder and I from the last software company, we started this together with, we each had a dozen friends who we sort of pulled in. So we're talking about a couple dozen people. And from there, we kind of spiraled out people join today, they're, 6th and 7th degree connections, have no idea that personally, but it's almost all that word of mouth. Or occasionally people will, post in some other, hey, maybe I was an early NVIDIA employee. And so I know 100, we have a private message board for other early NVIDIA employees. They might say there, right, hey, this could be a good fit for you if you're in this situation, click. Now, we don't just let people in randomly. Everybody applies. So they go to our website and they just fill out like a 30-second form saying, hey, name, contact information, but that sets them up for a phone call interview with one of our current members, where there's sort of a half-hour Zoom call where they, get to know each other there. And that's how we sort of curate who's coming into the community.
No, that's great. And then, tell me a little bit about the investment, the alternate investments, and I can obviously see a huge value in kind of pulling together each other's money into this special purpose vehicle. Can you talk a little bit about maybe how that works and what if you were to be part of that, what do you receive? Is it a K1 or what does that look like when you invest that way?
Yes. So tax-wise, you do receive a K1, which simplistically, if collectively this entity is making a $10 million investment into a private equity fund, whatever's on that K1, if you own 1% of it, we just divide that K1 by 100. And so if in total the SPV made $1 million of profit, you would get $10,000 of profit. So you'd get a $10,000 distribution. Your K1 would list this $10,000 profit, and everything kind of mirroring that umbrella one, but just scaled down for your personal situation there. And in terms of how we kind of identify those investments, the idea really is not to have a marketplace of, hey, here's 50 or 100 different things, kind of go at it. Because our basic thesis is, if you look at public markets, so the public stock market, it's an amazing vehicle because you really get accurate price discovery. So if I just go randomly buy Apple, buy Microsoft, buy Exxon, they're going to be priced appropriately because you have the SEC making sure there's not fraud. You've got full information. You've got millions of investors buying and selling to really dial it in. But you don't have that on the private side. So if I go randomly invest in a venture capital firm, I could get way overpriced on the fee structure because there's nothing to kind of keep them honest. There's no marketplace of supply and demand here, or, could straight up be fraud. There could be a whole bunch of things like that, and not picking on venture capital. That could be real estate, as you know. That could be private credit, any of these private asset classes. So really, you need to kind of do your homework there. And our thesis is that we can collectively, again, do that diligence, where we have a half dozen people as employees on this investment team who are all the time building relationships with general partners or GPs who run these funds. Because a lot of the good ones, they only really want to deal with serious counterparties. So you kind of have to work your way up the food ladder and show that you're going to meet your capital calls, that you're going to write big checks, that you're going to ask smart questions, et cetera. So our team is looking, probably at multiple opportunities a day. We try and boil that down to one or two a month that we think are really top tier, top decile of, okay, if you want real estate, this is a great real estate opportunity. Or if you want private credit, again, here's a great private credit opportunity. I will say we're actually tend to be pretty light on the real estate side for a variety of reasons. So it's more things like private credit, search funds, private equity, energy, litigation finance, music royalties, hedge funds. There's a bunch of these different asset classes. And the reason we go across a variety of them is we feel like, hey, again, let's say you're in 6 self-storage deals today, being in a 7th is not going to add that much more to your portfolio. You should probably just put more money into one of your best 6 that you found in the first place. But if you don't have any venture capital exposure, or you don't have any private credit exposure, you may have similar expected returns, but less correlation. So you will kind of diversify your portfolio. And so we find it valuable to bring people, hey, here's best in class over the course of a year, 1 or 2 best in class opportunities across a dozen different, very, interesting investment classes. Now, not every opportunity is for every member. Some people may be more focused on cash flow. Some people are more focused on taxes. Some really want to swing for the fences and say, hey, I want VC. My money will be tied up for 10 years, but maybe I can get a 25% IRR. There's no right answer there, but we say, hey, there are good versions of each of these. So we try and identify those good versions. And then basically we bring that to the community and we say, okay, here's very detailed diligence memo, all of the conversations we had with the underlying sponsor, what we like, what the concerns are. And then people actually discuss sort of an open forum on our platform. There's just kind of open thread where different members talk about, hey, I like this, I don't like that. We should ask the GP these questions. And then everybody just makes their own choice about if they want to invest in that particular opportunity.
Yeah. Okay. Now that seems like a great forum to be able to bounce the ideas off of each other, the questions off of each other. You mentioned a couple different things there. One, music and buying the music rights. I assume these are individual song rights, or could be whatever. But tell us a little bit about that. I've had another guest on that had that before, but it's been a little while. So I'd love to just kind of expose the audience to that, because a lot of times people just don't realize that that's even something.
Yeah. I think it's a great example. That one, as I mentioned, litigation finance, probably oil and gas. These are good examples where things that have, people often use the term equity-like returns. So you're talking, hey, maybe I'm expecting to get low double-digit rates of return here, but everything has risks. But the key is, do you have risks that are not the same as just general economic risk, where, if Microsoft goes down, you can bet Apple's going down at the same time, and so is Nvidia going down. But these things have uncorrelated risks. And so I think that's really what brings the value to them. So if you look at music in particular, the music rights, you double click on it. There's two versions of music rights. There's the composition rights. So I wrote the song Happy Birthday, and anybody who records Happy Birthday, if they're streaming on Spotify, if they're playing it in a movie, they're putting a Broadway show, I get some check, some royalty for that. And then there's the so-called master recordings of, okay, if Taylor Swift records Happy Birthday, then she has that catalog, and when Taylor Swift's version is played, she gets money for it. And that's where you sometimes hear this quote remastering of, okay, well, if she remasters and re-records it, then there's a new master there. And there's a lot of kind of nuance there about most of the contracts now. Actually, she's famous for having remastered some of her stuff, but very few artists actually are allowed to do that contractually. So initially I went in concerned about, hey, are you buying this vanishing asset that somebody can just go remaster? But it turns out it's really not how it goes. And unless you're Taylor Swift, you probably can't do that. But regardless, so you can either buy the rights to the song and the composition, or you can be the rights to the master record. And basically what you're getting is an annuity stream there of that royalty payment. And what's interesting is you'll see this in a lot. It's actually very similar to oil and gas, where when you first drill a well, especially if it's fracking, you'll have very high production. You'll get a whole bunch of production and it'll rapidly fall off and they'll kind of decay to some steady state. And you see the same thing with music. When a song first comes out, maybe very popular, and maybe you're getting $100,000 a month in royalties, and then it'll kind of decay. And after 3 years, it's maturing, and after 10 years, it's this flat $10,000 a month. But then it's an extremely predictable $10,000 a month, and you're going to keep getting that. And so you can kind of pick where in that curve you want to be. You could say, hey, I'm going to make a bet that I think this new Latin artist is going to be the next hot thing, and if I can get access, I'm going to try and buy partial or full rights to their thing early on. Or you can say, hey, I want to buy somebody who is, Cypress Hill or something that's big in the 90s, because I know that's not really going to change anytime soon. The same, Gen X or millennial who's listening to Cypress Hill today is going to listen to it again tomorrow in the same frequency. And so you're going to get a consistent revenue stream there. So you're really buying a forward royalty stream. And you could buy an individual catalog. I would not recommend that, both because the sticker price would probably be good. And again, you or I are not going to be in a good position to figure out a fair price. So what we do is we invest with a particular manager or group that says, okay, they're buying this catalog of 100 million or a billion worth of songs. And you're sort of looking at the track record of that person and say, hey, have they consistently been good at identifying winners? And maybe at that scale, they can actually help. If they buy half of an asset, maybe 50% share, they can try and work with the artist to do something to make it more popular and kind of increase the underlying value. And one of the things that's interesting about music is there was a real panic up to maybe 5 or 10 years ago that, hey, CD sales have gone away or are going down, and you're just kind of seeing this year-on-year decline in revenue. But and then you've got Napster and things like that. They're just pirating the songs, and business is going to go away. But what you've seen over the last 5 years is a really healthy rebound, and we're back now at all-time highs, but with a much more sustainable base, where Spotify essentially, and then YouTube and some other things, but Spotify being the core of it, has created this new floor of, okay, they pay a very predictable amount per stream. I don't know if it's a cent or fractions of a cent, but they actually pay, and they work with each artist and do it above board, and they have a consistent revenue stream where they've convinced people to subscribe to this. So it's actually a much more, they've gone through that valley of death and now come out on the other side with just a really strong tailwind and consistent growth. And I think never say never. You can't predict the next wave of technology, but at least for the near term, it looks like a very predictable and scalable. And, one thing that's interesting actually is a lot of intellectual property businesses, like if you think of, say, software, or if you think of medicine, emerging markets are terrible for them, because the government of India is just not going to enforce medical patents. They're just going to want people to manufacture the drugs so their population can use it. And, your patent is pretty much worthless in developing countries. So it's only really the US and Europe and Japan where you can make money. But in this, it seems like it's a different dynamic with these song rights, for example, where because even in India, they need to be delivered through a company of a decent size. You can't really pirate it in the same way. So they are actually seeing much more tailwinds from emerging markets than a lot of other intellectual property companies.
Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. Yeah, that's interesting. I didn't realize that even about the kind of the medical aspect of whether or not they could keep the rights and but yeah, very interesting. So you can actually sort of, that can be a strategy on the investment side for whoever's kind of managing it, trying to expose emerging markets to that particular song.
Yeah. That, and I think a lot of people look at, I think, Latin has become very big recently, and people are looking, maybe the next wave is more Afro beats kind of stuff. So also, if you can look at something that maybe is popular in Nigeria today, there's going to be a pretty small revenue pool there. But if you say, hey, this is likely to be exported essentially to the US and Europe, maybe you can buy low there and then see a big tailwind as Afro beats, for example, become more popular. And a lot of people have had success, as I said, on Latin music over the past several years on that.
Wow. Okay. Very interesting. Yeah, that's definitely a different one. What are some of the ones, you also mentioned, depending on whether or not somebody wants to invest and, look at venture capital, for instance, where, you may have a long hold, but you're looking to exit with a multiplier. But what about from a cash flow standpoint? What are some of the investments that you're seeing from that standpoint right now?
Yeah. I mean, I think I don't need to tell you about real estate. I think you've had many other guests who can probably go into more nuance better than I can there. And as you know, real estate is not one asset class, it's many. And you'll probably find the same thing if you go into something like private equity. Well, are you talking microcap private equity? Are you talking roll-up strategy? Are you talking turnaround strategy? So just as a flavor, if your guests understand the complexity of real estate, you can assume the same thing applies more or less to most other asset classes. Again, energy, there's different things on the spectrum where you can just buy royalty rights, or you can be an actual operator who's drilling and producing. You can buy pipeline companies. There's sort of any of the above are options within there. I would say if I'm looking at predictable, everything ultimately should have cash flow, right? That's the whole point. We buy any investments, you're going to get a distribution. But if you're talking about more predictable cash flow, I'd say probably the 2 biggest ones immediately come to mind for me. One would be private credit, and another one would be energy. So what private credit is just you're loaning money to companies. So rather than them borrowing money from a bank, which is more of a European thing, companies don't do as much of that in the US as they do in Europe, or issuing bonds, which of course is very popular in the US, but private credit is sort of a third version of lending money to companies. It tends to focus more on your lending to private equity funds, which that sounds more complicated than it really is in reality. What happens with private equity is I am KKR, let's say, and I'm buying a company. Let's say it's a $100 million purchase. Typically, maybe I'll put in 30 or 50 million of equity, and then I'll borrow the other 50 to 70 million, depending on the volatility and the interest rates and things like that. So same way with real estate, you're financing part of it. So this is really the loan to finance part of a private equity purchase is the main business of private credit. And they tend to have pretty good interest rates. Like everything, it's going to depend on the risk profile. But I would say generically, you're talking about probably low double digits interest rates on that. And there's a lot of debate about, hey, is there historical low loss ratio? Is that just because the economy's been good, or is it really sustainable? But I will say, if you look at the actual returns, you've been seeing people earn anywhere from, I don't know, maybe call it 8 or 9% on the low side to maybe mid-teens, like 15% on the high side, and pretty low default rates. And so you're still getting, these solid 12%, let's say, returns from private credit. And so that's great. There's a lot of big operators there where you can, get a lot of people will just say, hey, I'm going to put my money with a big, well-known operator, and I'm not going to push for sort of, the extra few points of spread. I want to take a somewhat more conservative approach. I think the main things you'd want to look at is, their track record. You'd want to look at if they have some through cycle experience. So how they do maybe if they're around during the great financial crisis, that would be a great example of, hey, do these guys actually underwrite well and mitigate their risk or not? Now, that's pretty far in the rearview mirror. It's almost 20 years. So even some very established companies don't have that track record. So you don't always get it. COVID was probably too short. It's almost an exception. It's just nobody really got that far into, or not many people got that far into distress. The other thing to look at is, do they have the ability to take over a company if it fails? So again, like real estate lending, well, maybe different from that. If the bank repossesses your house, they're just going to go and resell it. But in private credit, they often need to have the chops where if they repossess this manufacturer, they now have an operating team who can then step into the equity shoes and actually run that manufacturer, because it's not as easy to sort of flip it to get your collateral back in a lot of cases.
Right.
So that's private credit. The other thing to watch out there, it's not a great tax treatment. It tends to have ordinary income tax treatment. So people who are looking at private placement life insurance policies sometimes put that inside there because you get a big tailwind from that. Energy is another one I like a lot. And as I mentioned, there's different parts of the stack you can play in, but most of them have a pretty good cash flow component. So maybe the simplest cash flow is you're just buying royalty rights, where if you think back to it, somebody who owns a ranch in West Texas, turns out there's oil under there. That guy does not actually stick a well in the ground himself. He sells a lease to Chevron, and he sells it for some amount of money. And then he also gets a share of the production. Let's call it he gets an eighth of the production. So you can basically buy the mineral rights for any land you want to. And it's either already producing, or it's where you tend to make the most money is if you really know what you're doing and you buy ahead of the drill bit. So there's no well on it today, but you know that Chevron is planning to drill that acreage. Then if you buy that, it's going to go way up in value because it goes from a theoretical to an actual cash flowing instrument. You can get very good, well into the 20s kind of coverage if you do that right. And then, pipelines are another example that tend to be trade at low multiples and get good cash flow. And then there's this sort of, I don't know if risky is the right word, because I think it doesn't look like the kind of risk you used to have in drilling, but the so-called exploration and production, where you're actually investing in a company that does the drilling and pulls the oil out of the ground. Now, the reason that's probably a lot less risky than you might have thought historically you're saying, okay, there's this little pocket of oil somewhere in the ground and I'm sticking a straw down and I hope I hit one. And if I don't, It's a so-called dry well. And if I do, then all the fluid's flowing up. Really, the way that almost all the drilling in the U.S. works now is you're no longer drilling those liquid pockets. You're doing what's called hydraulic fracking and really horizontal fracking. People have probably heard of it, but what it means is there's a set of kind of oil-soaked rock, and it's much more predictable where that oil-soaked rock is. You drill down to that rock, and then actually the technology is amazing. You turn your drill sideways, and you go for miles along that rock, and then you fracture it. So then it releases the oil and it starts to come up. And it really makes it much more predictable how much oil you're going to get. And it's also much more front loaded. In a traditional well, you might have had your decline curve over, kind of gently over 20, 30 years. With hydraulic fracking, you get almost all of your oil production, or not almost all, you get the majority of it within the first couple of years. And the advantage of that both is you get your cash faster, but you also can then mitigate your price risk, because you can actually sell, if you know I'm going to drill 1 million barrels and it's going to be produced next year, I can go sell futures contracts for 1 million barrels and I lock in the price before I even start drilling. And so even if the price is all over the place, I know what I'm going to get. Now you lose the upside, but you also lose the downside there. And so it becomes almost more like theoretically a manufacturing operation of, I know where it is, I just need to go execute, and then I have locked in my price ahead of time. Again, I'm simplifying. There's a lot of more nuance than that, and getting in with a good operator is absolutely critical. But those are a couple of things, both energy and private credit, that I'd look at for cash flow.
Yeah, very, very interesting. I didn't realize you could do that even with the kind of the futures piece of the oil, just being able to lock it in. I would assume that's somebody that is going to have, this isn't going to be a single, oil well that they're selling futures off of. They've got multiple, and so they know that they're going to have that and be able to deliver on those futures.
Yeah, and I think you could do with options as well. And I'd say, none of this should your listeners do independently. This is really
Right,
the
right.
business model of the fund that you would be investing in, and what they would do there. Now, it's interesting, and actually, we've made a couple of investment in these exploration production groups, and one of the things we really look for is ones who do hedge the price. And you'd be surprised at how few do. Because the way I look at it as investors, I say, hey, these guys are earning something like a 70% return on equity in drilling, maybe north of 70%. You should just lock that in all day and take away this price risk. But as people in the industry will tell you, everybody in oil is a bull. They all think oil is going back to 100, so nobody wants to cap their upside. And so even though you could, lock in your 70%, you say, yeah, but if we have war in the Middle East, goes to 100, I'm losing a 200% opportunity here. I'm not going to do it. Oil can't stay down in the 60s here. So it's actually surprising how few places do that. And I will say, even if you lock it in, you're not totally mitigating your upside because there still is some residual production after the first year or two. And so, once you get to the end of 2 years, your then residual production is worth more, your land rights are worth more, et cetera. So you do get some tailwind there.
Okay. All right. And so what are some other things that you consider or the people in your group consider when obviously, building the wealth, but from a tax strategy, you mentioned some of the wealth preservation. What about anything else that you specifically dive into when it comes to kind of paying less in taxes?
Yeah, I will say, and maybe this will make your listeners feel better, the large majority of people feel like they are the one sector who's actually paying their taxes.
Right.
I think the way the government keeps itself in business is there's not that many ethical and legal ways to just totally dodge your bill. And I will say, if you have experience in real estate, there's nothing else that is as good at real estate at having these carve outs for taxes, your 1031 exchange. I can't go tell the government, hey, I sold Microsoft and bought Exxon, but I really just traded it, so I shouldn't be taxed on my gain. You can't get away with that there.
Yeah, exactly.
So, I will say I do think private placement life insurance is interesting. That tends to have very high minimums, like $1 million a year of premiums. We're actually looking at putting something together within the community where we sort of bring that premium down by sort of a collective plan. Haven't launched that yet, but we're working on it. So that is an option. I would say, although a few maybe more actionable things. One is through charitable donations. Of course, you still are, quote, losing the money, but if you are more excited about the things you'd give to personally than the taxes, that can be, especially if you've got an appreciated asset where, again, maybe I was at NVIDIA for a long time. So my $100 in NVIDIA stock, I only have a $1 tax basis on it. If I donate it, I get the full $100 of charitable contribution credit, but then I never have to pay tax on my appreciation from $1 to $100. So if I'd sold it today, I'm going to pay, 23.8% on that. So I'm losing my $24 there. Whereas if I donate it, I get maybe my, 37%, or if you're in California, you get 50% write-off. So I donate it, I've saved $50. If I, paid taxes, I would have only paid 25. So I still have a little less money, but you get a lot of bang for your buck on charitable donations. A couple other things in terms of people with really concentrated positions. One is they'll do something called an exchange fund, which is basically if I have a whole lot of money in a single stock, let's say I've got GE, you've got Bank of America, and then a third person has AT&T, we each contribute $1 million to this shared pool. And that's not a taxable event. We're just contributing it. But then we have 1/3 of the shared pool. And so it goes up and down. And so you basically have companies that will create these composite pools that are a bunch of stock from a bunch of different people. So it looks like an S&P 500 index, but I actually didn't have to pay tax to get that exposure. So it allows them to diversify out of a concentrated position without paying tax. And then one other one I'd point out is something called direct indexing. A somewhat similar idea. Again, if I wanted to put let's say $500 into the S&P 500, I could buy an ETF, or I could buy $1 each of these 500 individual positions. And direct indexing is basically I'm buying each of these individual positions. But then what they do and so that should perform the same, but what they do that's smart is as those start to have some stocks go up, some go down, they continuously sell the losers, and then they reinvest that money in a highly correlated winner. So again, let's say Chevron goes down, they'll sell Chevron and buy Exxon. I don't really change my expected return, but I crystallize that loss there. And so this direct indexing can actually throw off a lot of of passive income losses that you could use to offset the gain on some other passive income gain. So those are a few strategies that are interesting and well within the bounds legally. There's other stuff you can do in terms of like conservation easements that I would not recommend to anyone because I'd say it's both illegal and unethical, but these other ones are legal and ethical.
Right. Yeah. Makes sense. No, that's great. I mean, it makes kind of all of these, just how unique they are is just kind of another reason why being part of a community like Long Angle makes a lot of sense. I mean, otherwise, how are you going to have this exposure, right? That's a lot of kind of just difficult strategies to figure out on your own. But if you've got a group that's doing it and doing it successfully, they can certainly turn you on to it. I wanted to ask you about the life insurance one. You mentioned private placement life insurance. Can you describe that a little bit more? Trying to just understand that myself as to what exactly that is.
So I think there's traditional term life insurance, which is a good idea for probably anyone who has a beneficiary. If you've got dependents, a wife, kids who couldn't, if you got hit by a car, they wouldn't have enough money, then term life insurance is a great option, very inexpensive. And, you can buy it, say, for 20 years until your kids are through college and they don't need you financially anymore. There's the whole world of so-called permanent life insurance. Without trying to make my perspective too obvious on it, I think there's a lot of criticism of that is a very expensive way to accomplish your goals. And I think the real concern there being that the fee structures tend to be heavy and they're offset by some tax benefits, but a lot of things like whole life insurance or VULs or IULs, often the fee structure will outweigh the tax benefits. I think private placement life insurance is a bit of an exception there. And what private placement life insurance means is that rather than, say, going to a Northwestern Mutual, which is a great company, and buying their standard whole life policy, which is, I think, probably best in class version of whole life if you wanted whole life, what you do with private placement is you're going to some individual manager who, let's say, private credit is what they're doing, and you basically get a bespoke life insurance policy just for you that just invests in what that manager is doing. And now the reason that's different or can be attractive here is that you can pick ones that just invest in very tax inefficient assets. So the challenge with, say, like a VUL that is maybe tracking the S&P 500 index is the S&P is a very tax efficient vehicle to begin with. You're only getting 1 or 2% dividends a year. And so saving, you're saving 40 basis points or something by, saving the dividends, the dividend tax on an S&P, which is probably less than your fees. But if it's all going to private credit, that's maybe earning a taxable 13% a year. Again, if you live in California, that 13% could be taxed 6%. So, your net return is only 7% a year. But if you put that 13% into a private placement policy, let's say you pay a 1% fee load, well, 13% goes down to 12%, but now you don't have the taxes. So your net return, your tax savings is 6% and your fee cost is only 1%. So in that case, it ends up where the tax savings really swamp the fees and make it much more attractive. The big downsides I mentioned to these is that they tend to have, just by the nature of their bespoke design, their bespoke marketing, compliance, et cetera, it tends to be $1 million minimum. And again, not $1 million once, but like $1 million a year for, say, a 5-year or 7-year premium period. So you're having to put $5 or $7 million to work there, which both a lot of people don't have that much money, or even if they do, they don't want to put it all into a particular asset class. So that's, if you've got a couple $100 million, pretty, straightforward. But if you've got 10 million, that's kind of where the catch is. And again, we haven't launched it, but we're looking at basically, can we design a shared one so we can bring that minimum down to maybe 100,000 a year, which is still a big number, but a much more accessible number than $1 million a year. So if you did want private credit, or another thing is something like a high frequency hedge fund, where maybe they're producing great returns, 10 or 20% a year. But again, that's all ordinary income. And so if you can protect that from the tax treatment, and basically in terms of what that protection looks like, it both compounds in there untaxed, but you can actually, quote, borrow against the policy, which is effectively the same as making a withdrawal that's not taxed, providing you keep the policy in the black.
Right. Okay. Very interesting. And then how about anything else that you want to kind of share with respect to like wealth preservation, maybe estate planning, anything that you've seen that is unique or that is just worth kind of investigating a little bit more?
Yeah. I mean, I guess, a few things. I wouldn't say I have the perfect answer here. I think nobody really wants to ever deal with their estate taxes because you're morbidly thinking about yourself dying. Most people probably think we're talking decades in the future before it's going to apply. So it feels highly non-urgent. But I would say a couple of thoughts. One is people should be aware of if they do any, say, venture capital or early stage kind of investing, there's what's called the QSBS or Qualified Small Business Shares exemption, where you can get up. They recently raised the limit, but it's at least 10 million, maybe more like 15 million of gain that's just exempt from tax. If you invest in a company that qualifies, which means it's under a certain size threshold, I believe that size is 75 million in assets, and it can only be in certain lines of business. But if you're in a eligible line of business and it's below a certain size threshold and you make that investment, you're untaxed on it. So if you put $1 million into some startup and it becomes worth 10 million, you're getting the whole 10 million, no tax. So I think that's a very interesting thing. Maybe that's actually less of a estate plan, just another tax strategy. But then from a state perspective, I think what made me think of it is in general, you've got so-called revocable trusts, which pretty much everyone should put assets into a revocable trust because it means when they pass away, they don't have to go through probate, which is just sort of an expensive and burdensome process. If your money is in a revocable trust, then when you pass away, that trust just takes care of making sure it goes to your beneficiaries without the court getting involved. Now, the reason you'd get into an irrevocable trust would be twofold. One would be if you think you're going to have enough money that between you and your spouse, you each have a $15 million exemption, so you'll exceed 30 million. Then if you put money in there, you can start protecting it from future appreciation and lower your estate tax bill. It also gives you creditor protection, where if you think you're going to be sued tomorrow, you can't put money in revocable trust and hide it from your creditors. But if you have no known liabilities today and you put money in a trust, and then 5 years from now, you get in a car accident, somebody sues you, that's no longer your money. So that's no longer an asset they can come after. So that's sort of where an irrevocable trust comes in. And I would say what it does from a tax perspective is it protects your estate from any gains. If you donate $1 million of stock into there and then it grows to 10 million, that 9 million of growth is growing outside of your estate, so not taxed by estate taxes. So if you especially have assets that you have reason to expect will appreciate quickly, then those are the ones you want to focus on getting out of your estate quickly and putting into an irrevocable trust. That's how like Peter Thiel, I think he has $5 billion in his Roth IRA because he put assets in there that he had high conviction, his early startup shares in Facebook and, a couple other companies, he had high conviction they'd outgrow the market. I would personally argue he probably went over the line on what was legal. They probably were worth more than he stated when he made that contribution, as opposed to just perfect foresight. But, if you have good foresight about what will grow, then you could end up with that sort of thing.
Right. Very interesting. Well, Tad, this has been great. I've really enjoyed the conversation. How can people find out more about you, more about Long Angle, if they'd like to look into joining or making an application to join?
Sure. A couple of things. Now, I should say membership is free. So if anybody wants to join, they should be aware of that. If you're interested in getting involved with Long Angle, just go to our website, longangle.com, and you can set up for an interview with a current member there to learn more about it. I also do a podcast with a couple of my co-founders who run the group. It's called Navigating Wealth. And we talk about we're often interviewing members who have some expertise in an interesting area, like say cybersecurity or, AI or things like that. So we have our Navigating Wealth podcast, or you can just follow me on LinkedIn. It's Tad Fallows.
Perfect. All right. Well, thank you so much. And then I've got two other questions I ask every guest. One would just be any advice you would give somebody who's maybe they're not quite at the 5 million mark. Maybe they're just starting out in their investment journey. What advice would you give somebody like that?
I would say for that one, to really believe in that power of just the compounding and the smaller, consistent investments over time. So I'll say what I've done with my kids is every year for their birthday and for Christmas, they get, along with their other presents, they get one share of stock and they can pick what it is. So a little, Disney, my daughter just picks Spotify for this Christmas, stuff like that. And I've done that to try and kind of bring this to life for them. So my son, and then also for their allowance, they get not much, like $5 or $10 a week, actually closer to $5. But if they invest that, I'll match it 100%. And just based on that twice a year stock and then investing their allowance, my son's 14 and he's got almost $20,000 in his, brokerage account now just by making those consistent investments there. So that compounding really does, sneak up on you there. I think all the stuff we're talking about of alternative assets and private credit and private equity, you don't have to do that. And you very much should not be playing around with that until you are at this kind of 5 million, partly because actually the SEC, a qualified purchaser, you're not allowed to invest in those things until you have 5 million. So they are not necessary for good returns. If you've been putting your money into, the NASDAQ, ideally, you have gotten 20% returns like the last, 10 or 15 years, which is just a mind-boggling rate of return. So I think just because it's simple doesn't mean it's not a good approach.
Yeah, I think that's great advice. How about a book recommendation? It doesn't have to be investment or real estate related. It certainly can be. Just something you've read that's been impactful.
Yeah. I would probably say, I'll cheat and give 2 here. From an investing perspective, there's a guy named Dave Swenson. He passed away a few years ago, but really a phenomenal guy. He ran the Yale Endowment for probably 20 years, and he just posted phenomenal returns, which I think is impressive, partly because, you're helping a good cause there. You're helping nonprofit really make money from their money. And I think he was at double-digit returns for multiple decades. And he could have become a billionaire on Wall Street, but he intentionally still made a lot of money at Yale, but nothing like the same money because he really believed in the mission. But he wrote a book called Unconventional Success, which really just lays out for an individual some of these insights you can take from the kind of advanced portfolio management that he went to put into managing a, $30 billion endowment, but apply that to your own life and how to think about different asset allocation classes. So Dave Swenson, his books I'd be a big fan of. From a just fiction perspective, one that I read recently, which I really enjoyed and I recommend to many people and they've all enjoyed, is a book called Tomorrow and Tomorrow and Tomorrow by Gabrielle Zevin. It's a phenomenal book and allegedly about a few people who start a video game company. So if you're into video games, you'll love it, but I have zero interest in video games, but it's almost like you take your sort of Russian, novel from the 1800s, this sort of interesting sweep of human characters, but set it in a, 1990s US setting, and just a fantastic book.
All right. That's great. 2, I don't think we've had yet on the podcast. So Tad, I appreciate it. This has been really good. I'm glad we got a chance to do this. I think we'll call it a show. Thank you so much.
All right. Thank you, Keith. I enjoyed it.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors. And we would love more than anything else to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.